want to talk about some investment strategies of three big people. Investment strategies of three well-known people. And I want to start off with Warren Buffett, because he is pretty much the wealthiest investor in the world. Bill Gates and Carlos Slim are richer, have more wealth, but they started their own company and grew their own company. I guess Warren Buffett did too, but Warren Buffett's company is an investment company. It's not Microsoft or a telecommunications company. It's like his company was an investment firm that bought a bunch of companies. So if you're ever going to take investment advice, it's from this guy and from me, but also from Warren Buffett, because me and Buffett are definitely on the same level, right? So this is what I like to call, I read over all of his strategies. This is what I like to call the, the get rich slowly technique. People are used to the get rich quick schemes. This is the get rich quick slowly scheme. And it's much more effective than any get-rich-quick scheme. By the way, there isn't really a get-rich-quick scheme apart from winning the lottery, which your odds of that are 1 in 292 million, right? So this is called the get-rich-slowly. And so for those of you that don't know, Warren Buffett, he wasn't rich at all 60 years ago. And slowly his company's been building wealth and building wealth and building wealth. And it's been very steady for about 60 years. Like, it's had high growth, but just for a very long period of time, and that's why he's so rich right now. So what does he do? So he looks for undervalued stocks. I'll just write undervalue. That's the very first thing he does. Now, there's also one more thing I want to say with that, is that he only really makes one big decision every 2 years. So he said in an interview that in his entire business career, he only made 25 good decisions. That's it. He makes one every 2 years, and that's it. Now, he makes a bunch of little ones along the way, but he purchases a large portion of a company every couple of years. So, and what are these companies? They're companies that are undervalued, and a lot of if you don't know how the stock market works, a lot of the times when bad news comes out, people will just take all their money out and the value of the stock will go down. They'll sell, the value of the company goes down. And if there's good news, a lot of people will start buying and be like, buy. And people pretty much overreact to good or bad news. And so what Warren Buffett does is he'll look at a company that gets some bad news, and he will be like, okay, well, that bad news doesn't really affect the long-term outcome of the company, so let's buy a large portion of it because there'll be good news coming soon. So that's what he does. And so that's just a basic thing. But in terms of specific stocks, like what he invests in and stuff, very first thing is he avoids tech. And so I live by this one too. Avoid tech. Apart from the only one I've ever been invested in. I've been invested in two, actually, so I guess I kind of went against it. But Apple and this company called Tech Systems, which I nailed on both of them in terms of investments. So stay away from tech because it's very, very, very unstable. Back to my last video, the Silicon Valley video, 95% of startups fail. Is that the number, or 90% fail? I think it's 90 to 95%. So only 1 out of every 10 or 1 out of every 20 tech companies will actually succeed and profit and be that $1 million plus company. And so that's why Warren Buffett avoids tech, because even big companies, like look at BlackBerry. BlackBerry was one of the most valuable tech companies in the world, and all of a sudden it's within a 2-year span, it was worth 1/10 as much as it was before the 2 years. Saying that it's still a multi-million-dollar company, it's not that massive powerhouse. I had a BlackBerry. And I had 2 of them actually, because one broke. And a lot of my friends had BlackBerries, and then they just couldn't keep up. They weren't competitive. their stock value just went down and down and down, and Apple took over. Apple and Android took over, right? So tech companies, they aren't reliable. All right, so avoid tech for investing. That's from Warren Buffett. So he also looks at companies that reinvest their earnings and pay dividends. So we'll just say reinvest and dividends. That's another big strategy of his. So he doesn't like companies that take out their money and pay the CEO $1 billion, right? He will never invest in that kind of company, like a hedge fund. That's a whole different story. But yeah, he likes dividend-paying stocks, which is fairly common in all wealthy investors, if most of them. If you have to take one thing away from all these investment videos that I'm going to make right now, is that dividend-paying stocks of safe companies of like Coca-Cola, those are the best kinds of stocks that you can invest in long term. So look out for high dividend, not too high though. There's some stocks that pay like 15% dividends, but that's because the stock is so volatile and it goes up and down and they might go bankrupt. And so just look at safe dividend stocks that pay somewhere between 3 and 5%, and those are the best kinds of stocks you can invest in. Because not only do they pay you 3 to 5% every year, but the value of the stock usually goes up 1 or 2 or 3% or more, right? So look for those kinds of stocks. So he looks for companies that have high profit margins and low debt. So high margins and low debt. So for those of you that don't know, a lot of companies take out a ton of debt. So there are some companies out there, I think AT&T might be one, that have 45 times as much debt as the company is worth. How does that make any sense, right? So he looks for companies that have a debt to market cap ratio of like 3. Which is fairly good. When people think, how could you take out that much money when your company isn't worth that much? Well, think about it when you get a mortgage, right? You can buy a $100,000 home on a 40 grand a year income, or a $100,000 mortgage on a 40 grand a year income, right? So same thing with big companies. They do that too. And so, yeah, I think that companies that don't have a lot of debt, I think Apple might be one of them. Don't take my word for that. I think Apple and like Google might be another one. But don't take my word. They might have tons of debt. But yeah, that's just an investment strategy. So high profit margins. So he doesn't invest in like food companies, right? They have the lowest profit margins in the game. When you think about it, when you go to a food store and your grocery store and you buy a piece of food, every time you buy something, that company might only make a 1%, 2%, 3% profit on whatever you're buying. So again, if you want high profit margins, stay away from the food industry. Unless you're making some sort of like high-end food or like chocolates or something, then that might be okay. But don't be like a company farmer and sell broccoli. Anyways, saying that, farmers are very important. So good job, farmers. So what else does he do? I guess we'll have to erase some of this soon. This is actually kind of funny. So he looks for moats. What does that mean? Moats. I was kind of confused about this. Oh, that was the weirdest looking S I've ever written. So what does he mean by moats? That looks like a 5. So he looks for companies that have a protection against its competitors. So it's usually they have, one thing that separates them from the pack of everyone else in their industry. So again, I'll go back to the BlackBerry example. They didn't really have any special thing apart from the keyboard, which wasn't too special, but they didn't really have anything to protect them from other phone companies coming in and other tech companies coming in and taking away their business. It was whoever had the best marketing campaign won, or whoever had the most innovative ideas won in the phone space, right? And BlackBerry didn't have any of those innovative ideas. They had BBM, BlackBerry Messenger. That was innovative at the time, but then iPhone within a year came out with iMessage, and that just nullified that. And yeah, so anyways, he looks for company moats. Yeah, so I think that, oh boy, what are ones with company moats? A lot of the companies in the S&P 500 index have some sort of moat. I think that most of them do, actually. Actually, yeah, that's what he said here. A lot of them do. So that's why I invest in a lot of those. But like Geico's a big insurance company. Although that's not really a moat. But anyways, he has a lot of companies. Anyways, I'm going to talk about some more Warren Buffett stuff here. Sorry, I just did not make sense there in the past 30 seconds. But that's okay. What do you guys think of Warren Buffett? Do you think he's a good person? Do you think he's a smart person? Actually, he got asked the question, if you could have one superpower, what would it be? And he says, I wish that I had the ability to read 8 times faster than anyone else on the planet. Because he likes to take in information, and that's why he can invest so well. Because he just knows a lot about business. He knows a lot about what's going on in the world. So that's why he's been able to attain such wealth from knowing so much stuff about the business world. So what else does he do? So, yeah, crap. So I guess he has some tips for the average person, which I wrote down. So what he says, this is for the average person, not for himself, but for the average person. He says, if you don't know what you're doing, invest 90% of your money, or 90% of your investment money into the S&P 500. So that is the S&P 500. It's pretty much the 500 top companies in the States or the world or whatever it is. But any big company is on that. It's an index. So you can even invest in the index itself, betting that all of the top 500 companies will be better in the next year. So you can actually do that too. So if you don't know what you're doing, invest 90% of your income in one or more of those companies, or 90% of your investment income, and then 10% in government bonds. So this is kind of a standard strategy of most really wealthy people, is they'll actually, no matter what, they will invest a certain amount in government bonds, even if they're crappy, because they want to always have like a safe bet that they will have money coming back, even if it's not keeping up with inflation, So 10% in government bonds. Now, we have a few more things here. One more and very important thing, which I'm going to put a star beside, which I've mentioned before, is it's never sell when the market is bad. Okay, that is very, very important. And I follow that religiously. So what a lot of people do when they invest in a stock for, the first time or whatever, if they're a rookie investor, they will invest a lot of money in a stock, and then let's just say 2 weeks later, the stock starts going down. Maybe some bad news comes out. So it starts going down and down and down and down, and they sell. They're like, okay, I don't want to lose any more money. I'm going to sell. That is the wrong decision. And why is that? Because a lot of the times, well, there's a few things, but a lot of the time, that stock will rebound. Most companies don't go bankrupt. If you're in the S&P 500 especially, you're not going to go bankrupt. You're not going to lose all your money. And they're going to rebound most of the time, except for BlackBerry. Man, I'm just really ripping on BlackBerry today. So never sell when the market is bad. Don't sell during a recession. Buy more during a recession. That is how you get rich. Or you can short when the recession starts, like the Big Short. But a lot of people can make a lot of money when they buy stocks when they're at their lowest during a recession. So I like to say, buy when the market is okay and buy more when the market is bad. Don't buy when the market is amazing and good. I learned my lesson once, and I never made that mistake again. When I started out investing, Actually, I haven't sold the stock. It was a Canadian TD bank stock, which I bought at its peak or near its peak. And I'm just starting to, break even on that because the stock plummeted a little bit and now rebounded back. Anyways, got off track there. So never invest when the stock market is bad. And I guess one more thing that he does, which isn't for the average person, he likes to invest. He likes to invest a lot in one company. So what do I mean by that? I'm running out of room for the 15th time. He likes to invest a lot of money in one company at a time. So as I said, he makes one good decision every couple of years. So what he'll do is he'll buy enough stock to have control over the company, or very close to control. So he could, in a company that's worth $100 million or more, he'll go and buy a controlling interest in that company so that he can decide what to do with the company. And so that's what he does. He's not worried too much about diversification like a lot of people are. Like for me, I like to diversify for the most part, more than Warren Buffett does with his strategies. But yeah, so Warren Buffett doesn't diversify too much. He makes very safe bets in one company at a time. So that's what he does. So yeah, he is worth $70 billion, Warren Buffett. What do you think of Warren Buffett? I know I asked that already. What would you do with all of his money? $70 billion. He's 82 years old, maybe a little bit older. What would you do with that money? Well, I don't know what I would do. I actually found this dream house in Kelowna, British Columbia. It's the perfect house. It's like there's mountains and there's a lake in between the mountains, and the house is on a mountain, and it's just beautiful. So that's what I would do, and it's only $8 million, which is attainable one day. I think that I could probably do that one day. But, well, we'll see in a couple of years. Maybe the house will still be on the market.